Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Tuesday morning. We're 30 minutes from the bell, and we're going to take a look at what's going on with the broader averages, bonds. Let's take a look at some currencies here this morning, as well as gold. So starting off with the S&P, and as always, if y'all have any questions, feel free to type them in. Phone lines are open for your request. All right, we have a very neutral S&P right now. So if you're looking for a choppy market that has the capacity at this point to break up or down, right now what we have is 5 yellow candles in a row. This tells me that not only has the downtrend been broken, but the dominant psychology really is neutral. The market is simply sitting here asking what's next. We know what this week in terms of data has in store. JOLTS today, ADP, non-farm payroll, GDP, all of that is this week. And then we also have probably the biggest week in terms of tech earnings coming up. Well, actually right now this week. So we have high concentration weighted names, namely in the S&P and the NASDAQ. Of course, there'll be some impact on the Dow, but we have those major Mag 7, a whole bunch of those, not all of them. Of course, NVIDIA is not still for a month, but there are plenty of high impact stocks releasing this week. So lots of data to focus on, which is sort of a welcome relief to back when for the better part of a month and a half, 2 months, everything was really sound bites and headlines and what's the next evolution of the tariff narrative. It's nice to get back to data. Data is a rate of change study of numbers, right? We've got this data. What is it doing compared to what we expected? What is it doing compared to the previous? You can sort of see a trend, right? And the further away we get from data, the more difficult and more oftentimes volatile trading can be. The last 3 sessions of the S&P, well, I shouldn't say the last 3, the last 2 sessions of the S&P, and it looks like maybe a third, are operating well within normal volatility parameters. This is good news for nearly us all. Same thing with the NAS. The NAS is a little bit more bullish, but let's remember where the NAS ends this week is largely going to be contingent on those earnings. So if you haven't yet looked at, in terms of what we've got with earnings, just bear with me. Let's see here. Oh, I need to open that up. Hang on. I wanted to show you all the earnings narrative that I'm looking at. Here we go. Okay, so this is the earnings narrative that I'm looking at. Open up this menu to the left and you'll see we've got Honeywell, Coke, Pfizer, UPS, Booking, Mondelez. These are all stocks that are heavily weighted in their respective sectors, and these sectors in turn are heavily weighted within the broader averages. Visa's coming out today. That could be a big one for financials and therefore the Dow. Caterpillar, Meta. So this is where those Mag 7s kick in tomorrow. Meta, Microsoft, Qualcomm. On Thursday, MasterCard, another heavily weighted stock in financials. Lilly, heavily weighted stock in healthcare. Here comes a little stock called Apple. And then we've got Amgen, another stock heavily weighted in healthcare, Amazon. And this is what we want to remember as we look at each one of these stocks. For example, Chevron and Exxon will probably have more impact on the Dow and S&P, but they're going to have a massive impact on the XLE ETF. So these are all the things that we want to keep in mind as we're going through this list and determining what it is that we're likely to see in terms of impact from these different earnings. Now, I'm not looking to trade earnings. I actually hate earnings season. It's a lot of noise, it's a lot of spectacle, and it's a lot of false thinking that a potential massive move is a place where we manage risk. Don't like it, don't trade it, but do respect what it can do to the stock itself and therefore the sector and the index. All right, so NASDAQ is about as bullish as any of these indices are. Dow is probably about as bearish as any of them are, but while a step behind the S&P, it has been recovering since that UNH gap down on earnings. 4 neutral candles, no downtrend. We're definitely going into a mode where the stock market's saying, look, everything that we thought was catastrophically possible, it's not as if it could not happen, but we drove the Dow down to 37,000 in terms of expressing that opinion, right? The market's always a forward-looking machine. What do we think is going to happen, and where are we going to drive the price? And let's remember one of the most important truths of trading: crashes never happen when we're talking about crashes, right? When the broader group of market participants are talking about the market could crash, or here comes a recession, or fill in the blank on whatever fear-mongering type headline we've been inundated with since February, those things are never going to happen when we're all expecting them to happen. Are sell-offs of the magnitude that we saw in April surprises? Of course, right? Because if they weren't a surprise, we would already have discounted it into price. It would have already been reflected. And I'll tell you what, gang, not 8 in 10 traders understand that concept. Not 8 in 10 traders will accept that if something's being talked about, it's already been discounted. If something's being feared about, it's already been discounted. So it's not a matter ever of deluding ourselves into thinking we have sleuthed out something where we know something that the broader markets do not. Are there traders that can do that? Yes, but then all they're doing is spending time in a very different place. They're not spending time in the charts. They're spending time studying other metrics, but it's not price action. So keep that in mind. I think a lot of times traders lose sight of the fact that, let's just presume we're always going to be the last to know. All right. So that's what we've got there. So these are going to be the more yellow candles we get, the more we have a compressed market. Narrow sideways ranges. Narrow sideways ranges have a couple different things we can do with them. I'll be talking a lot more about that at 10:30 when we get into our swing trading conversation. But let me just mention this. If you can continue to find that neutral consolidation, that narrow range, you can set up two really good plays as long as you have directional bias. And that directional bias might be the tricky thing here, especially this week with the kind of data we're getting. I would presume a little bit more weakness in, say, the Dow, even in the S&P. I might be a little bit more optimistic and presume potentially a breakout on the NAS, but the breakout direction is going to be the most difficult. In fact, probably the best thing to do, rather than presuming a breakout right now, is presuming that price is going to remain within a range and then just play that ping pong within the range. I think gold is a really good example of that. Let's go take a look at GC. Gold is a really good example of we're just in a range. You can see it. Back and forth we go. This is where, yes, eventually there is a high likelihood that price will find its way north of the highs and south of the lows, whatever it may be. But that's the range we're stuck in. So I'm going to presume the range is going to hold until it doesn't. I'm not going to, especially, here's the worst thing you can do. All right, let me show you. Because really, I think anytime we're talking about a sideways market, there's 2 types of traders that tend to love them. The one type of trader that tends to like a sideways market, and both of these are viable, is an oversold, overbought trader. So that trader is going to look at this area as resistance, and this trader is going to look at this area as support, right? They look for things to remain in a range. Overbought is just another way of saying resistance. Oversold is another way of saying support. That's probably the lesser of group of the participation of traders who like sideways markets. The more common reaction is something like we would see on this day and on this day. And this is classic sort of Momo trading, right? There's a lot of bullish momentum and traders will buy on that. I will tell you, of the 3 things you can do in a sideways market, number 1 being nothing, which doesn't get considered enough. Number 2 being this Momo, right? This Momo trigger. And number 3 being the overbought, oversold, right? The worst thing you can do is number 2. The worst thing you can do is say, hey, there's an up market, let's buy into that high. Because chances are, especially when we're in a sideways environment, we're going to move right back down to the lower end of the range. why not focus on an oversold entry? So these are things that are really that have to do with timing. And the timing in a sideways market is probably the most difficult because in an uptrend, you can buy a higher high. In an uptrend that has higher highs and higher lows, you can buy a higher high knowing that there's still enough frenzy usually around that trend that someone else is going to be willing to buy higher. If you buy the dip, well, that's the best risk reward you can get. But if there's no dip, you may not be able to get an entry, right? There's no free lunch, gang. Nothing is perfect. But the absolute, frankly, worst thing you can do is number two. Just buy as something's moving higher rather than acknowledging that there's probably a range. Let's see if we can't get some better timing. That's going to help your risk reward. That's going to help, frankly, your ability to take a profit when prices move from one end of the range to the other, the second leg of the trade. And I did a whole video on this at the Simpler Trading YouTube channel on Friday. Check it out. And it's basically how I set up these compressed markets. All right. So let's see, questions. Oh, I did want to take a look at the energies and currencies really quickly. Crude oil remains very, very weak, gang. Let's just not get too bullishly ambitious about crude. And this is another thing that I want to make sure everyone understands. There's this thing that goes around saying that if the dollar is weak, it's good for the stock market. That is categorically untrue. There are plenty of uptrends that have had a strong dollar. There are plenty of downtrends that have had a weak dollar. And there's plenty of downtrends that have had a strong dollar, right? So that's actually an erroneous correlation. The causation of a stock market going up while, say, the dollar's weak is monetary policy. And not just the monetary policy of the US, but the monetary policy of Europe. The Euro US is the largest symbol that's traded of any kind on the planet. The Euro US in the foreign exchange or Forex. It's reflected in things like 6E, which is the futures contract version of that, or FXE, which is the ETF version of that. But at the end of the day, it's that exchange rate between the euro and the US. The euro and US have nearly a 100% negative or inverse correlation, meaning the euro's going higher, the US dollar has to go lower. They will not go in the same direction. So if the European Central Bank is keeping the euro weak or strong, whatever it is, the dollar's going to go down. And if the euro weakens, the dollar is going to go up. So one of the things a lot of traders have been looking at, saying, "Hey, we have a weak dollar. That's good for stocks." Not necessarily. Remember, there's a causation before we just kind of get lazy with the correlation. So those are things to keep in mind. I do like the long side of the euro. We do have a lot of ECB chatter as of late, but I do like the long side of the euro. This would be a long 6E position. This could be long calls in the FXE. This could be a long position in the euro versus US. These are all things we could look at to take advantage of the 6E, which really is also a short position in the dollar, a bearish position in the US dollar. All right. One of the questions we have here is, when would I use a strip or strap option? So strip or strap options, for those of you that don't know, is something that I do where it's a multi-leg entry, but you can do so in a cash account. I trade in a cash account. That's what I teach. It's a rare thing to say I trade in a cash account. Most traders like to sell premium and play spreads, but I would do that anytime there's a lot of volatility. So strip or strap is, in my use of it over the decades, it's typically a 2-to-1 ratio of calls to puts or puts to calls. So whichever way you have directional bias, if I'm bullish, that would be a strap. And then I would buy 2 calls for every 1 put. Strap. Strip is the bearish version, 2 puts for every 1 call. And usually I'll look at something like that when there's a lot of volatility. And then rather than placing a stop loss, I can use that single option, 2 calls to 1 put. That 1 put is basically the risk offset, right? It's the safety net of the trade. So usually in a high volatility environment, Eddie, is when that strip or strap option strategy makes a lot of sense. Or for those of you that don't want to necessarily have a tight or have one at all stop loss. Because while it's not a 1-for-1, I mean, what's the point of hedging a trade? I detest hedges. The only hedges in my life are in my yard. I do want a directional bias. There's no sense in something working in my account while something else isn't working. I'm one step forward, one step back. However, it is a really tactical, directional uh, kind of arrangement, if you will, of calls and puts, that the puts losing value if the call's working should not offset the gain. And I will also say if the calls are losing value, the put will not completely offset the gain, but it will lessen the blow. All right. So that's something I've been doing and teaching for many, many decades. It's not a commonly discussed option strategy because most traders who want to trade options, multi-leg options, want to sell premium and buy premium and do much more sophisticated things. I'm a directional trader in a cash account, and there are very few multi-leg directional trades that are friendly to a cash account. Strips and straps are definitely one of them. All right. Next up is what is the strongest sector right now? Ren, really simple. The strongest sector right now is coattailing gold futures, and that would be GDX. Gold is not as strong as it once was, and neither, therefore, is GDX, but they're both bullish. So this is where the timing of waiting for a slight move to support more of that oversold entry would be much better for something like GDX. You could say the same thing for Newmont Mining, Agnico, Wheaton, WPM, Royal Gold. There's a number of symbols that, well, I would say, actually, let's take Royal Gold off that list. WPM, Agnico. I think we were looking at a couple other names as well. Harmony. And, of course, the number one weighted stock in GDX, which is Newmont Mining. So that's GDX. Yep. After that, by the way, after GDX, you've got actually, I think it's staples and then utilities, or then utilities and then staples. But those are your top three strength names right now. Yeah. Okay. Next up is looking at, let's jump on over to bonds. All right. For as much conversation as there was, but oh my gosh, yield curve inversions. When's the last time we heard about that? Well, it's just as useless now as it was then. I did a video and I did a top tier outlook newsletter on the way yield curve inversions actually work. The yield curve has been inverted for the better part of 2 years. It's the initial inversion and the reinversion, which is what affected 2022. That is so important. Remaining invert, and by the way, they've uninverted. Now, what happens to yield curve inversion junkies is that when, say, the 2 and 10 are done inverting, they'll just look for another pair. Oh, it's the 3-month and the whatever. So be careful with that. Ask yourself a simple question. Anytime that will, again, rear its ugly and rather dumb head, this yield curve inversion conversation, have we gone anywhere new? Are we trading higher than about the 122 handle? Are we trading lower than around the 110 handle? Are we going anywhere new? And during the worst of all that brouhaha, we really weren't going anywhere new. We were still stuck in a range. Volatile, yes. New, no. Right? And so keep in mind, bonds remain very, very erratic, but just don't get suckered into, yield curve inversions are people who like to sound macroeconomically intelligent, when in fact, it's just not. Please. We saw so much fear mongering preceding the bounce about the yield curves. I remember on a Sunday I was on X and everyone was talking about the yield curve inversion and how it's a harbinger to the next, whatever doomsday. And that's when the equity market started rallying, because that analysis is absolute bunk. Be careful, because I'm sure it'll come back around. That's just the way the stock market is when it comes to this kind of drama. The stock market sometimes acts like a bunch of middle school 12-year-olds, just the drama and passing notes in class and whatever. We have 2 ranges right now in bonds. The 10-year looks a lot more interesting to me. It could be something that I'd like to get long calls in, but I want to see at least more neutral or more bullish action here. All right. So yeah, anytime you go, my favorite time is to go on a Sunday on Twitter, X, whatever you want to call it. And you can get a little bit of insight into all the X conversations about whatever macro du jour is the conversation happening. And they're usually going to be ones you'll see all over the place. But again, peak panic and look what's happened since. So it's not just terrible analysis. It's an opportunity cost, gang. So be careful about the fear mongering. All right. Be good to each other, gang. I'll see you all tomorrow.